I just want to say thank you for taking the time to listen to the update on what estate tax changes we saw with the One Big Beautiful Bill Act. If you have additional questions, I'd be happy to help answer those or connect you with one of our team members to kind of dig deeper into, what opportunities you might have that you might want to take advantage with these estate tax changes. So thank you again for your time. Hi, everyone. My name is Heather Williams. I'm going to spend some time today going over some of the estate tax law changes from the One Big Beautiful Bill Act. I hope you find this information helpful, and we at KB are happy to assist to work with you and your attorney to help make sure that you're achieving and you have the plan in place that helps achieve your goals and aspirations for your estate, or takes advantage of lifetime gifting and the opportunities that you can plan for around that. So, thanks for tuning in. Today, I just want to walk you through some of the major changes in the estate tax law thanks to the One Big Beautiful Bill Act. This really is a big deal for estate planning. It's one of the most significant updates we've seen in many years. And for once, of course, these changes are meant to be permanent, but so no more worrying currently about the sunset provisions. So really, what's new? So they're not going to be temporary like they were under the TCJA. Starting in January 1st, 2026, the exemption is going to jump to $15 million per person. Without the OBBBA, we'd be looking at a drop to about 5.5 million per person. So this is a huge win in the planning world. Plus, the exemption will keep growing with inflation, though keeping track of those numbers in the future gets a little tricky. But let's dive deeper into what this means for estate, gift, and GST taxes. So to put it simply, only estates above the $15 million per person or $30 million for couples will owe federal estate tax. For context, the current exemption today is about 12.9 million. And without this law, it would have dropped to the 5.5 or $11 million per couple. So this is obviously a very big increase. The same $15 million exemption applies to the generation skipping transfers, which makes multi-generation planning much easier. This also opens up more opportunities for dynasty trust and long-term wealth preservation for families. For the gifts, the lifetime exemption is unified. So the gifts that you make during life and then what's left in your estate all count towards the same 15 million. But don't forget, there's also the annual exclusion every year. So for 2025, you can give up to $19,000 per person per year without touching your lifetime exemption. So this is just separate and additional. And the IRS reviews that number every year and considers 1,000 incremental updates, but they do not update it every year. They kind of look to the CPI. So for a married couple, they can combine their annual exclusions to give twice the amount to each person. So for 2025, that means a couple could give up to $38,000 to each person without using any of their lifetime exemption or having to report it. So now let's look at what this means for estate planning strategies. So what does this mean for planning? Well, there's an extra $2 million on the table per person compared to the current levels. So that's $4 million per couples. This means a lot more flexibility, especially for business owners and real estate holders. The techniques like estate freeze and charitable planning get a boost. Business succession plannings can take even more advantage, as well as combining this with valuation discounts. But you don't need to wait until 2026. The current exemption levels are still really useful. But always make sure that your gift tax reporting is in order. And I want to note, if you're a Florida resident, you need to consider the other states because they are often lower, their exemptions are often lower than the federal exemption. But one of the most important concepts to understand really is portability. So what is portability? So in plain English, it's letting a surviving spouse inherit any of the unused exemption from their partner. So the technical term is called DSU, Deceased Spousal Unused Exclusion. So there's a catch, of course, it's the IRS. You have to file a Form 706 on time with extensions. So I know many are probably saying, why bother? Well, by filing, it could mean up to a $6 million in tax savings down the road. So it's basically free insurance against future estate tax surprises. Of course, they say the law is permanent, and that is government speak, as we know, until further notice or until the next administration change or disagreement. So let me show you a real example of why filing portability matters. So for example, if a spouse dies in 2026 with an $8 million estate, there's no estate taxes owed. But if that same spouse files that executor files a 706, they can preserve the unused exemption of $7 million. So the result is the surviving spouse now has $22 million in total exemption, which could save millions down the road. So filing for portability for larger estates, it's almost always a good idea, even if there's no current tax due on the first spouse to pass. And the dissue cannot be retroactively revoked or taken away by the IRS, Congress, or future tax laws. So to kind of wrap it up here on the estate tax law changes, the new $15 million exemption gives us real certainty for estate planning. My advice, it would be a good idea to take a fresh look at your estate plan. Portability may or may not have been considered when you last updated your plans. And with these new permanent changes, it's smart to review and make sure you're taking advantage of every opportunity. Erin, are there any questions?
Yes, we do have a couple questions here. Are gifts taxable to the recipient?
All right. So, no, under the federal tax law, a person who receives the gift is not required to report it as taxable income. And this applies regardless of the amount that they receive and if it's over the annual exclusion amount.
Okay, and this one kind of goes the other way. Can you deduct the gift on your taxes?
Unfortunately, no. Gifts to individuals are never tax deductible for the person who gives the gift. Tax deductions for gifts are only limited or allowed for donations to qualified charitable organizations. I just want to say thank you for taking the time to listen to the update on what estate tax changes we saw with the One Big Beautiful Bill Act. If you have additional questions, I'd be happy to help answer those or connect you with one of our team members to kind of dig deeper into, what opportunities you might have that you might want to take advantage with these estate tax changes. So thank you again for your time.